Hello and welcome. We're all looking to make good investments, smart investments, and one space where you can do that is by looking at turnarounds. Here's a business where we've seen a couple of years where cash flow has been a drag, margins have been a drag, inventory has ballooned, and in order to try and retain or capture market share, they've let go of pricing in a big fashion, and therefore discounts have been large. All of that likely to unwind, plus there is a change in promoters. So you've got a lot of things happening. You have a private equity firm coming in and buying stake, and we're talking about VIP Industries now, if it's not already very obvious. And you also have the promoter who's come out and spoken to us as well as plenty of others to talk about what he feels to be a business which will take time to turn around. But then you have a private equity player coming in and buying large stake, and therefore is of interest to us. Can new promoters turn the business around? How easy is that going to be? Well, the current promoter certainly doesn't feel so, and we'll pull out what he said. But what I'd want to understand better is that there has been some commentary which has come through as well at the end of Q4, where they've said that we'll see a bottoming in terms of inventory in Q2 FY26. How reliable is that, is what I'd want to know. Whether that is even doable, double-digit top-line growth and maybe a 15% aspirational margin. Can they really do that? And if they do, then the numbers will turn around very, very quickly. Otherwise, too, it will, but maybe it'll take a year or two. So we'll have to play that well. The third piece is with regard to growth and margins, and I spoke about that just right now. Double-digit growth and margins coming through. E-commerce is hurting offline. What's the play therefore? Is Bangladesh dependency a problem given all the issues that are happening there? Will pricing challenges turn a corner? And this is a big one, because this will likely also lead to gross margins expanding. So want to wait and watch on that one. So can the following happen? And I've spelt it out. Double-digit top-line growth, gross margins of 50%, and EBITDA margins of 15%. And if this happens, you'll likely start to see a bit of a turnaround where the business is concerned, and valuations on the basis of all of this, how does it stack up? Let's look today at VIP Industries, and I'll start off with what the company is all about. This is no small one. It's the #1 organized luggage maker in the country. It was founded in 1968. Well, not just the country, it's probably one of the largest in the world. It's in fact the second largest in the world. And when I spell out the brands, you'll probably get better context of it. It's selling products in 45 plus countries, has 14,000 plus sales points in India alone. And it's Asia's largest, but the world's second largest luggage maker and travel gear company. Let's talk about some of the products that it has and what it does. Typically hard luggage, soft luggage, duffel bags, backpacks, ladies' handbags, travel accessories. In terms of brands, VIP, of course, is the marquee brand. But outside of that, it does Sky Bags, Carlton, Aristocrat, and Caprice. All of those are solid brands by their own standing. So really, you have here a company with all of these brands, one of the top companies in the luggage space in the world, trading at around 6,000 crore in terms of market cap. And that's where it starts to maybe become interesting. Let's look at the value chain now. First, you have in-house designs, which thereafter is taken to manufacturing. Manufacturing happens in India and Bangladesh, and thereafter distribution happens. There are e-tailers, EBOs, as well as e-commerce. The distribution happens across all types of retail. Now, you're looking at the business model. One, you manufacture in India, Bangladesh, outsource the selected products. The India-Bangladesh combined has around 10 factories. 8 factories are sitting in Bangladesh. They sell through own stores, multi-brand shops, e-commerce and dealers. And the main markets are India, and it exports to over 45 countries. Raw materials, well, they use polymers aluminium, fabric, zippers, trolley parts and hardware. Some of that, of course, core commodities as well, and therefore something to be kept in mind. Suppliers, they are largely reputable vendors, both Indian as well as international. Raw materials, of course, face pricing pressure and volatility. They're managed via contracts and inventory, and of course the finished product also, at least in recent years, has faced pressure with regard to inventory. So that is something to contextualize and keep in mind. Let's quickly look at the metrics that we'll track today when it comes to our VIP industries. I'll start off with the income statement, the balance sheet, the cash flow, the return ratios, shareholding, street cred, street coverage and valuations. So the typical 8 metrics that we take, we'll stick to those today on a VIP industries. I'll start off with the income statement. You've got revenue which has grown at a 3-year CAGR of 19%, so not bad on that top line growth, but that has, when you're looking at FY24 versus FY25, which is on your screen, you can see the shrink in terms of top line. So there has been pressure with regard to growth. They, in order to avoid giving up market share, what they've done is they've done large discounting, which is impacting their margins. So while top line is held up as a result of that, margins have been sacrificed. Look at margins, they've come down from 9% to 4%, and look at the margin trajectory FY23, 24, 25. From 15% plus, it's fallen to just 4%. Can this recover will be the question. I've given this a neutral because they've been able to hold up on the top line in a difficult environment. So that's the one point which I'm liking here. Of course, at the cost of margins massively, and therefore that's a thumbs down, that part of it, and therefore profitability is taken a knock. But given all of this, you also have to contextualize it going forward. Will inventory unwind happen? If that happens, you could likely start to see the top line also go up. You will also likely see margins pick up and profitability pick up. How much is the question? But the repair work could well start very quickly. So you want to keep your eye out on that one. So we've given this a neutral for the moment. Let's look at the balance sheet now. You look at equity of around 500 odd crore, nearly 600 crore of equity is what this one has. When you're looking at you know, the market cap, I did mention this, the market cap is around 7,000 crore. So the price to book is for you to look at, just about 11 times price to book. That is expensive. When you're looking at borrowing, again, this is important. Borrowing has gone up, so has inventory. So, and this is no surprise. We spoke about this, that inventory and borrowing, both of those have risen. And I'll give you a little bit of a glimpse on what has happened. Inventory, which used to sit at around 300 crore in FY21, or between 300 to 500 crore between FY19 and FY21, rose to nearly 600 crore in FY23, so 100 crore increase, and 900 crore in FY24. Even FY25, the inventory is at 700 crore, which is elevated in terms of their levels. So some of those have actually contributed to the increased short-term debt in the company. So the short-term debt has gone up in the same line as inventory has inched up. So that is something you want to keep in mind. The second is your trade receivables have also inched up in similar fashion. So from the 200 crore number in FY22, trade receivables went up to 250, then 320 in FY24, and now at 370 in FY25. So some of those pieces need to unwind themselves in the balance sheet. So while the debt has risen, it's not 1:1 in terms of debt to equity, and it's risen because of some of these factors. So you want to keep all of that in mind. But that's with regard to the balance sheet. We've given that one a neutral as well. And unwind on those parameters could likely lead to balance sheet cleaning up well. So we're waiting and watching on that one. Let's look at cash flow now. And the cash flow from operating activities, there you go, some of the numbers on your screen, saw a huge jump in FY25 as a result of that inventory unwind. Mind you, I clearly said it, 900 crore inventory down to 700, so that 200 crore unwind reflecting on the cash flow of FY25. Clearly visible, that 200 crore differential. And what you're also likely to see is that continuing to unwind. So your cash flow will improve, but it's erratic, right? FY23, look at the cash flow to EBITDA. FY24, look at that number. So you want more stability to that. Can that happen? That's where we're keeping this again on neutral. But otherwise, if you looked at the FY23 and FY24 numbers, a clear thumbs down. It's just that we can see the unwind happening in FY25. That's pushed me to give this one a neutral. So again, something you want to keep in mind. Return ratios. And this becomes important because you've seen margin headwind come through, you've seen profitability slip into losses, and therefore your ROCE numbers are bound to take a knock, and that's exactly what's happened when it comes to the ROCE number. It's taken a bit of a knock. We're currently sitting in negative. They've not given us an ROCE guidance either. So when guidance was sought, it wasn't given as part of the con call. So we'll really have to wait and watch as to where the ROCE goes as those numbers come back. We've given this a firm thumbs down with regard to the way in which the ROCE metrics have moved. Now let's look at shareholding, and this is where it becomes critical, because what's happening with regard to shareholding is you currently have 52% promoter ownership, and promoter ownership largely driven by Mr. Dilip Piramal, who is the chairman, and he will remain the chairman, but in a non-executive role. And he currently owns around 52% of the company. 32% of that will go to a consortium of investors, including a multiples private equity, which has a track record of turning around businesses. So it's not like they've sold a 32% stake to an investor or a community which doesn't have a track record of turning around businesses. You have an investor coming in which has a track record of turning around businesses. We had an Investec note which also suggested that multiples not only has a track record, but along with some of these other investors might get diluted, but will still command enough say in management matters, and therefore you might well see a multiples private equity lead this turnaround if it were to happen. And how quickly will it happen is really the question, but it will likely be driven by multiples private equity, is what even analysts, one or two, are suggesting, and we'll obviously have a conversation with one of them as well, so that will give us a better perspective. So those are some lines for you on what exactly is transpiring with regard to the shareholding pattern. 20% will continue to be held by promoters, even existing promoters, even going forward, but 32% will be held by multiples private equity. They've also done an open offer for 26%, as is mandatory. They might well succeed in that open offer, in which case their shareholding goes up. So again, something to keep your eye out on. A lot of moving parts here, but surely thumbs up with regard to the shareholding pattern, because you have a large investor coming in and validating this. Let's look at street cred. 1 month stock price 13% up, 6 months 18%, so good returns over the last 6 months. But 1 year stock price is flat, year to date also flat, and 5 years a 78% return. We've given this a neutral as a result of that. Let's also zoom into valuations now. When you're looking at the FY26 and 27 valuations on Bloomberg, those are the numbers you're seeing in terms of price to earnings. So certainly not cheap, but if a turnaround is at play, there could be an upward bias to profitability, and you could see those valuations correct quicker, right? So in case of a double-digit top-line growth along with a 13% margin, you would likely see the price to earnings multiple shrink to 56, not 75 in FY26, if that were to play out. But we'll obviously have to wait and watch whether that does. H1 continues to be, or rather the expectation is H1 will likely continue to be weak, but we'll again have to wait and watch as to what happens at the end of Q1. But that's something you want to look out for. The last one is analyst recommendations. 4 buy calls, 3 hold calls, 4 sell calls, return potential negative 21%. So we've given this a thumbs down as well, not looking good from a return potential perspective. But does that change given the fact that we're seeing a change of ownership? Plenty of moving parts here, and therefore we'll have to continue to monitor this. So those probably watching this maybe a week or two later, you might want to factor some of these issues in. Let's quickly also look at all of the ratings. Let's see how those stack up. Income statement neutral, balance sheet neutral, cash flow neutral, return ratios too neutral, and all of those are your parameters. And what it ends up doing is giving it a 3.5 on 8 on our KYC rating. Now let's go across. We spoke with Mr. Dilip Piramal, Chairman. Listen in to what he had to say to us.
In all our existence of 53 years, we have been the market leaders.
Correct.
And in the last 5 years, however, we have been losing market share. We are yet market leaders, but very close. The other two companies are very close to us. But more than that, we have, like last year, in the year ending March 25, we made losses in all the 4 quarters, which is a disaster.
Correct.
As far as my company goes. And also, we are a family-owned company. And my next generation is not much interested in running the business. So for me to take care of the shareholders' interest, and I am the major shareholder, so it is my interest also, our management is not in very good shape. So it'll take some time,
But it'll come there.
Of course, of course. The overall fundamentals are very good. Markets are, tourism is the largest growing industry in the world for the last 10 years. We are a very, very minute part of the tourism industry. Luggage is a very small category. And our fundamentals are very good. Luggage is the same product everywhere. There is no special luggage for America or Germany or Indonesia for that matter. It's the same product everywhere. So it depends what is, like, we have not gone into that area at all. We sold a little bit of exports in some Gulf and a little bit in Europe and all.
Well, that's very candid words coming in from Mr. Piramal, but let's go across. We have Jinesh Joshi joining us from Prabhudas Leeladhar Capital to talk to us about what he believes and he tracks VIP industries closely. Jinesh, welcome. I want to first start off with this entire promoter change. How significant, and does it change the way you view the counter yourself? Do you think that there is a significant turnaround possible and likely?
Sure. See, a turnaround possibility is definitely there. We need to understand that the existing promoters had some succession planning issues, right? And there was this news that some kind of exit was planned. And this was in the news for quite some time. And finally, we have had the exit come through. Also, if you look at their top management over the last, say, about 2 to 3 years, we have seen quite a bit of instability over there. Now, what will happen with this a new P guy coming in is that you might see a change happen at the top management level. And that is where you will see perhaps the turnaround come through, at least in terms of earnings. So I think definitely, yes, a change in management at the top level can lead to a turnaround for sure.
And how quickly can this happen, Jinesh? They had spoken about a turnaround as early as H2 FY26. Is that likely? Because some of these things take time. It's taken 1 year to unwind 200 crore of inventory. Can they quickly unwind the balance in the first half?
See, I think it's a slightly wishful thinking to assume that maybe in second half that could come through, because we need to understand the problem area of VIP. See, the problem began with the balance sheet. I mean, as you pointed out, that in FY24, the inventory was at about 900 crores. They were able to liquidate that slow-moving inventory in FY25 by about 200 crores, and the current inventory on balance sheet is approximately 700 crores. So what will happen is that perhaps in 1Q, you may not see that old inventory get liquidated, because typically 1Q is a peak wedding season and you may want to have a fresh stock in the market. So maybe the liquidation perhaps could be slightly back-ended is what I believe. And then what happens is that once this happens and you are fully out of that old stock, you may start perhaps fresh in FY27. So I think 26 will be a year of reorganization where you will see the balance sheet strength improve, right, with the inventory liquidation happening. And see, your entire P&L mess, we need to understand, is linked to high inventory on balance sheet. Because of high inventory, what happens is that your warehousing cost is high, your freight cost is high, your working capital gets elevated, and to that extent, the debt on the balance sheet is also high. So once the liquidation happens, the cost reset will happen on an autopilot mode. But I think that will take some time. So I think, to sum it up, 26 perhaps will be the year of reorganization, and you can expect normalcy to come through from FY27 is what I believe.
So, do you expect a double-digit growth likely in FY26? Let's not talk. Let's go away from balance sheet cash flow. Let's look at P&L core. What do you expect on the top line as this unwind happens, and what do you expect on margins in FY26?
See, 26, I don't think they'll be able to report a double-digit top-line growth. Because if I talk first about 1Q, what happens is that we need to understand that 1Q is impacted by Operation Sindoor. So to that extent, obviously, you will see some softness come through in 1Q. And whatever recovery perhaps one expects will be slightly back-ended in 3Q onwards. So I think in FY26, double-digit growth to my mind will be very challenging. Even on the margin side, see what will happen is that while in FY25, their EBITDA margin was at about 4%, what we need to understand is how the gross margin trajectory has moved over the last 4 quarters. I mean, if I remember right, in 1Q, their gross margin was 44%, but the exit gross margin was 47%. So if some bit of a recovery comes through on the margin side, at least in say FY26, given the cost reset thing that I just mentioned, the recovery on the margin side could be slightly better, is what I believe. So we are expecting about 11% EBITDA margin to come through in FY26.
11% EBITDA margin, okay, and 15% realistic, Jinesh, eventually maybe FY27, 28?
See, could be. See, why one may think that the journey from 4 to 15 optically is like quite a big one to kind of execute. But if you look at the numbers of the past, I mean, FY23 and all the prior years, if you look at it, VIP was a 50% plus gross margin business with an EBITDA margin of 15% odd. So, I mean, what we are expecting by 27 is that once the normalcy comes in and this entire pile up of soft luggage gets liquidated and you are back to normal pricing. See, right now, what is also happening is that due to excessive discounting and the price war that is there in the market because of high liquidity, you are seeing the top line growth also remain under some pressure. So once in 27, you are having to work on a normal base. I think a slightly higher growth with a 14-15% margin may not be a wishful thinking.
And Jinesh, if someone were to take up VIP, do you believe multiples is well placed to drive this turnaround?
See, I mean, if you look at their history, I mean, some of the consumption names that I can recollect is PVR. Another one is Arvind Fashions, even delivery for that matter. So they have had this history, and I think if we go by that, perhaps we are in for some kind of a turnaround in VIP as well, with some level of changes happening at the top level, which will drive this turnaround.
Okay, point taken. Jinesh, last question is with regard to return ratios. So FY27, right, balance sheet shrink will be sharp FY26 and therefore the base of FY27 will be lower. With margins recovering likely, what should the realistic return ratio be on a business like this?
See, I mean, if you look at the past history, excluding the last 2 years where they were into mess because of all the issues that I spoke of, VIP has been a business with ROE, ROC of about 20% plus. So even in FY23, the numbers were like quite decent. So I think that is a steady state number which one should be aiming at in a year which is FY27, which can be expected to bring in some stability into the business.
Point taken. Thank you so much, Jinesh Joshi, for joining us, giving us all of that perspective. So, viewers, we've broken this down the best we can. We've looked at the business itself. We've looked at the metrics. We've looked at what the management had to say and acknowledge that maybe it's not the best time to be at a place where they are. And we've also analyzed this with Jinesh Joshi of Prabhudas Leeladhar. But with that, completely out of time on this edition of KYC from me and everyone who puts this show together. Thanks so much for watching.